So ladies and gentlemen, let's have an energetic round of applause and please help me welcome our next speaker, Vikash Wadekar.
Hi, good morning everyone. Good morning, that's great. I think tea and coffee is working fine. So thank you so much for inviting me here. We are happy as a group at Motilal Oswal AMC to talk to all the advisors, especially after this lockdown of 2 years, one-to-one. So we're going to talk to something very different today, very interesting topic I'll be covering here, because since morning, a lot of discussions have happened, and the question remains, what as an advisor we should do. And exactly that's what we are going to talk about, how one should use these passive strategies. I'll be using these strategies, very, very important, in clients' portfolio to not only increase his wealth, but also at the same time to increase your businesses. Okay, so let's begin. So I'm not going to cover this. I think all of you know these active and passive strategies. One thing I'd like to just clarify, globally, there's nothing called active and passive mutual fund. The discussions are majorly based on active strategies and passive strategies. Okay, here we see that, it's too much of active mutual fund, passive mutual fund. Both of these are needed in the client's portfolio. We'll be discussing that in further slides. Yeah, so what is that we are going to discuss here and try to, come out with is, a different perspective about, what is that this passive offers you as an advisor and for an investors. So, importantly, if you look at here, which the previous session, the panel discussion discussed about the scalability. They are very, very simple products. We are at 11 lakh, 12 lakh crores of equity AUM of mutual in the industry, and if we have to reach 100 lakh crore, what do we need? Do we need another 500 NFOs? We need simplicity. We need simple products. Okay, if you go to Tier 2, why Tier 2? You just leave Bombay, go to Thane and Kalyan, you will see people don't know about mutual funds, not investing in mutual funds. So when you talk about simple indices, is actually help you to reach out to investors. This becomes a very good starting point. People can track these indices very easily. That's how it helps you to scale the business. You don't have to, and as an advisor, you don't have to work upon, which one to choose. There's a lot of advisors spend a lot of time on a lot of analysis, a lot of research on who has done well, who will be doing well. Ideally, you should be spending more time with investors and managing their behavior, their emotions rather than choosing a fund. So that's how it helps you to scale your business. Of course, you save a lot of time and energy. Very, very important thing is advisors alpha. Most of the advisors still think that the alpha has to be generated by the fund managers. But look at from this point of view, you as an advisor manage clients' portfolio from debt to equity to real estate, probably, his estate planning, that's what Pratik mentioned in the morning. And how do you expect a particular fund manager or 3-4 fund managers to give you alpha? This is something in your hand. You have to help client to reach to his financial goal, and that's where passive plays a big, big role in creating alpha. There are a lot of products available which we discussed. We'll be discussing how to use these. That's going to be main focus of my presentation. This has been discussed for a long. I've been using this slide for a long. Investing is a game of probability. But, when you know that it's a game of probability, we need not spend too much of time or analysis, but just do simple things for investors, which works for you, which works for investors. Yeah, so what simple thing, how do you gain market? How do you gain, scale your business? Just buy the market. As simple as that. This has been very popular. Last 2 years, a lot of people are saying, just look at me. Okay, this is on a lighter note, but this actually makes our life much simpler. This is what one should look at, that it's not, when you go to passives, it's not that you are settling for averages. You refuse to believe in magic. Somebody will come, XYZ will come and he'll give me that alpha. This is what a passive strategy talks about, and that is how one should look at this passive strategy altogether. As I mentioned, you have to generate alpha for your client's portfolio. You have to help him to reach to his goal. Okay, so you'll have to use different strategies to generate returns and alpha in client's portfolio. And one of the strategies, core and satellite, that's where passive plays a big role. So what happens when you actually do, and this is what an advisor is expected to do. Okay, when you have a good blend, when you build a portfolio which is based on active and passive strategies I am saying, here we only keep talking about funds, but strategies. When you say passive strategies, helps you to reduce cost drastically, okay, substantially. It helps to get clients' mind share very easily, rather than doing too much of selling a XYZ fund manager. That's how you can acquire more clients. Okay, when it reduces cost, and when it has a substantial portfolio, ideally it's 40 to 50% what passive should be. What it does is reduces volatility in the client's portfolio, because as market matures, it becomes very difficult for you to generate consistently outperform, and that's where market wisdom help you. So reduce cost, reduce volatility, and at the same time, you always do much better job than most of the active guys. So that's where for core strategies, one should look at passive, and that slowly start building on. But you continue to have an active strategies, which includes a lot of not only mutual funds, but a lot of other strategies which we discussed in the morning, like PMS, AIF, and direct equities as well. This is another reason, why one should look at passive. I'm not going to talk about performance here. Look at the range. Look at the range here, which moved, suppose if you look at to a large cap category, so many guys are underperforming. And look at the range, from top high guys on all the segment, large and mid cap, small cap, focus, ELSS. Look at the guys of the range, the number one guy is at 30% and the another guy is at 5% also. Okay, so you are betting on a lot of guys. That's where when you have a simple portfolio, which makes your life simpler, okay, and easier to manage clients' portfolios. The another approach, which all of us know, is asset allocation. It plays very important role. So it's not only about active or passive, but also asset allocation. And passive plays again a big role here. When you offer low-cost products, okay, it reduces volatility, but at the same time, it does a fantastic job. This is on a lighter note. But asset allocation, you just don't have to worry about, what you need to do for your client. Just have an asset allocation and manage it for 10 years, 15 years, and you will see fantastic results. The results can be like this. So this is a portfolio that we have created here. Okay, let me go to next slide first. Yeah, so these are the different asset classes. Pardon me for the numbers. I'll read it out. So we have 4 asset classes here: gold, debt, international equity, and domestic equity. And you see, all guys keep changing their stance, who is number one on calendar years. But when you actually have a portfolio which is made based on some strategy, like, here one strategy which we have got here, in 2008, if you look at aggressive and conservative. Look at where domestic equity was, where domestic equity was and where the fund was. So it reduces volatility and negative returns drastically in the portfolio. And this is what client gets. What you need to give him is experience, and this is the experience. This is the equity market, this is your debt market, these are all your asset allocation strategies. Aggressive, conservative, and moderate. So such portfolio strategies actually save a lot of your time, and the experience of the client is fantastic. And this is what one should look at, and that's where client will be definitely ready to pay money for you, or the fees for you. So when we go to client always wants 2 things. Whenever you meet client, he always asks for 2 things. One is, naya kya hai? Okay, and second thing, what he expects from you is alpha, right? Correct? So today, the first 2 strategies we spoke about was asset allocation and your core and satellite strategy. At the same time, when you look at factors, you also add alpha in the portfolio. Factors are very popular globally. Okay, these strategies one should look at, Indian investors and advisors should look at in their portfolio. I'm going to cover very brief about today how to build a portfolio using factors, because it's a very short time to talk about all the strategies here. Yeah, so this speaks a lot for itself. Yeah, so here is a guy who has made alpha, and the other guy who has made money by investing in factors. This slide will actually tell you what factors are. Till 1960, there was nothing called market return and alpha. But there are a few intellectual guys identified alpha and market returns, right? But if you look at today's time, where do you see alpha? This slide tells you that factors have a potential to outperform market. Okay, so though they are a passive strategy, at the same time, they also have potential to generate higher returns for you. So these are the popular 4 factors which are known as low volatility, quality, momentum, and value. I'm not going to confuse here which one to use. I'm going to only talk about 2 strategies, and I'll tell you what to do about additional strategies. So here was the first analysis where I added momentum strategy. Momentum strategy is something which talks about, factors are not only just smart beta, that's why they are called factors, not smart beta, because there is a mathematical model which is built based on investors' behavior. So market wisdom is also captured, and market investor behavior is captured through a mathematical model. Yeah. So that basically, that's what exactly what factor returns are. So when you add a momentum strategy, which will tell you what are the recent performers always in the portfolio, and look at the performance. If you look at Nifty 500, the first slide talks about only Nifty 500, which is the market return. If you add momentum 15% in your client's portfolio, see what happens. Your return drastically goes up, okay, and your volatility goes down. I should say risk-adjusted return also goes up. When you add 30% momentum in your client's portfolio, look what happens. Very importantly, your volatility of all the period remains almost same, but your returns have improved across all the period. That's the power of momentum strategy. That's what factor does in your client portfolio. This is one strategy only I spoke about. There is another strategy called low volatility. Again, it's a market behavior. Why a particular stock is low volatility? Because market is not interested. Market is interested only in those fintechs of the world or delivery platforms of the world which actually don't make any money. Okay, so that's why the good stocks actually are part of the low volatility strategy. When you combine low vol and momentum 50%, see what happens. Okay, your returns, look at the returns, and we have compared this with Nifty 200. Look at the alpha which you have generated. At the same time, look at volatility. This strategy has outperformed almost all active strategies. So when you add this in your client's portfolio, again, it also gives you alpha, but reduces volatility. Now, low volatility is a strategy which ideally should be looked at clients who are very conservative, who don't want to look at equity at all. Or a balance advantage kind of a category, conservative or aggressive. See, when you add, so we have done one analysis here. The first is equity market. Look at the returns. Your debt, equity and debt. So market and debt. And here, debt with low volatility. See what happens. Your returns are much higher than across all the strategies. At the same time, your volatility is again lower than equity market and equity and debt portfolio. That's what factor does it to you. So this is what I spoke about, which are ready-made portfolios which you can add a particular fund, 15%, 20% or 50%, and that's what they do it to your client's portfolio. Okay, but there is another way also can look at is a tactical and DIY. You call your client always wants to, there are some advisors definitely who wants to use these strategies based on market. They want to time market. There are different products available. Say domestic funds are different indices are. I think this morning somebody asked this question. You have a debt strategy, you have multi-asset strategy, you have factor strategy, you have international strategy. How to use these strategy on tactically and DIY? We have made a lot of portfolios based on your client needs, your understanding of clients. In fact, we have the largest team on the research side, 7-member team which is headed by Mahavir Kaswa. who has spent time with over a decade with S&P Dow Jones indices. And what major task of their team is to create these portfolios and give it to our advisors. A lot of boutique firms, wealth firms like us for the platforms, a lot of analysis that we give it to them. So please connect with us to know how these portfolios help you. These are all unbiased portfolio which has been designed by us to give it to you, okay, for your clients' benefit. And this actually help you to charge your clients because they are in unique portfolios, again, from existing funds only, that how it helps, how it does over the period, that something can help, we can help you out. Please get in touch with us for these portfolios. Yeah, I'm done. I think last 30 seconds. So this is what I spoke about at the beginning. Behavioral management is something very important for you, rather than just talking about doing a lot of research. Okay, what client wants. These are what client keep on doing it, right? But as an advisor, what you should do is something like this. This is what you have to do. Right? Set expectations, manage behavior, risk profile, and goal-based investing. So adding passives to your client's portfolio, what happens is, गम और खुशी में फर्क ना महसूस हो जहां, फर्क ना महसूस हो जहां, मैं दिल को उस मुकाम पे लाता चला गया, हर फिक्र को धुएं में उड़ाता चला गया, मैं जिंदगी को साथ निभाता चला गया. So thank you so much, Cafe Mutual. Add passives to your portfolio, investor portfolio, and get peace and also returns for your clients. Thank you so much.